Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. On this episode, I speak with Amanda Lynam, Managing Director and Head of Macro Credit Research at BlackRock. She shares her outlook for private credit. Then, iCapital Chief Data Officer Robert Huntsman weighs in on your question of the month related to AI. And for the private market poll snapshot, I will give you a preview of our 2025 market outlook. We hope that you enjoy this last episode of 2024, and we wish you all the very best this holiday season. Okay, let's get to it. In today's private market poll snapshot, I'm pleased to share with you the overview of our 2025 market outlook. This upcoming year promises to bring solid underpinnings for the U.S. economy, supported by steady U.S. consumer and easing inflation. However, notable and multiple uncertainties or wildcards do exist, and more so than in years past. This is why we expect a positive outcome for risk assets, but with it, we also expect a wider distribution of these possible outcomes. Let's dive in a little bit deeper to show you just what we mean. The economic foundation for 2025 does look solid, and the U.S. economy is expected to grow at 2%, or its trend rate. And consumer spending is forecasted to once again be a key driver, supported by rising household income and household wealth. Beyond this, there are four factors that are further contributing positively to the U.S. outlook. First, ongoing rate relief remains front and center, and the Fed may cut by another 75 to 100 basis points by the end of 2025, bringing front-end rates to 3.75%. This should further shift financial conditions from being a headwind to growth to becoming a tailwind. Second, deregulation, specifically in the financial and energy sector, should fuel growth and ignite animal spirits. Financial deregulation would ease credit constraints, and in the meantime, a supportive approach to oil and gas production could increase U.S. oil production, potentially lowering energy costs and boosting consumer spending. Third, we expect a further uptick in capital markets activity. M&A transactions are expected to rise by 25% in 2025. This would reverse the year-over-year declines as we have seen over the last few years and bring the transactions back to pre-pandemic levels. And finally, business productivity is also on the rise. Indeed, productivity growth has expanded at an annualized pace of 1.8%, which is above the post-GFC average of 1.5%. This bodes well for growth. Still, 2025 will likely also bring with it plenty of wildcards. For example, aggressive tariff strategies could stifle trade and growth, but on the flip side, if they result in negotiated trade agreements with partners, they could support growth instead. So that's why we call this a wildcard. The tax cuts are expected to be extended, but the timing and scope of tax reform is still unknown, and there are serious questions about budget deficits. And finally, there's a non-zero chance of the Fed pausing its rate-cutting cycle if inflation proves stickier, which could complicate the economic outlook. The bottom line is, while solid fundamentals suggest a positive baseline for risk assets, it is these wildcards that will ultimately determine the actual investment outcomes next year. Depending on which way the tariffs, taxes, budget deficits, rates, and inflation go, the market may outperform or underperform our baseline expectations. So what are those baseline expectations and what are the investment implications? Well, assuming persistent equity multiples and consensus earnings growth, the S&P 500 fair value could reach 6,600 by the end of next year. However, we fully expect that the return profile for equities will likely be punctuated by periods of higher volatility, more so than we saw in 2024. Also, the America First policies under the second Trump administration could create distinct company and sector winners and losers. And finally, given the expected rebound in capital markets activity and less volatility than public markets, we think this could be a great year of opportunity for private markets. Overall, we think investors should be well served to stay invested, maintain their strategic asset allocations, and remain nimble to capitalize on potential volatility and dislocations throughout the year, especially in public markets. And that's your outlook for 2025. For more information, please visit our iCapital 2025 Market Outlook website, and I hope you can also join us live for our Outlook webinar in January. My guest today is Amanda Lynam, Managing Director and Head of Macro Credit Research at BlackRock. Amanda heads original market research across diverse asset classes, including private debt, global corporate debt, as well as real estate lending. Amanda, thanks so much for coming in today.
Thanks so much for having me.
It's great to see you. I'm very excited to have this conversation today about private credit, but also we'll weave in a little bit of public credit discussion as well, because you've spent your career covering IG, high yield, leverage loans, and now, of course, private credit at BlackRock. So let's start with, what is the outlook for you for private credit heading into 2025?
We have a structural growth forecast for private credit that is fairly optimistic. We believe that the asset class can grow to $4.5 trillion by 2030, which is about a 15% compound annual growth rate from the current figure. That growth forecast is underpinned by four factors. One is investors' desire for diversification and increased comfort with the asset class. Two is borrowers' desire for certainty of execution and flexibility. The third, which I don't think is talked about enough, are structural shifts in the public debt and equity markets, which we think are allowing private credit to fill a financing void. And then fourth is ongoing selectivity in bank lending that has allowed private credit to establish itself as this third and viable funding option alongside the banking markets, alongside the public debt markets, which on net we think is a positive for financial stability. I think the one really important point, if we were having this conversation 2 years ago and we were talking about private debt or private credit, we would have been talking about lending to middle market companies. Really, that would have been the focus. I think over the past 2 years in particular, the definition of private credit has really changed. It's now
Expanded.
It's broadened and it's expanded, and I think it encompasses a much wider range of opportunities, and really anything that can be originated, structured, and held by a lender is now in the purview of private credit. So that may explain why we have such a optimistic growth forecast on this asset class, because we think that it's actually expanding into new areas of finance.
I'm glad you brought that up, because it does seem to me like it's a little bit more optimistic than even some of the consensus analyst forecasts are for the growth of private credit to go, again, from $1.7 trillion today to $4.5 trillion by 2030. So why do you think BlackRock is somewhat more optimistic about private credit?
I think we're undergoing a bit of a paradigm shift in private credit on a few fronts. One is there's a lot of scope for the traditional institutional investor community to increase participation and allocations in private credit, especially when you think about alternative asset allocations in private equity or real estate, which are actually much larger. So I think there's a lot of scope for growth there. But then we see new avenues of investor participation: insurance companies looking for capital efficient yield, retail investors looking for income and portfolio diversification. The growth of certain BDC structures has allowed retail investors to access private debt in a more simple and efficient way. That expanding addressable market of investors is one kind of part of that equation. The second is the expanding addressable market of borrowers. So private credit is now sizable, scalable in its own right as an asset class, meaning it can compete in areas where it previously could not, including the public debt markets. It's also servicing investment-grade borrowers, many of whom may have saturated the IG debt markets across currencies and are looking for private solutions. So I think the definition of private credit is changing. The addressable universe of both investors and borrowers is changing, and I think that's really fueling our above-consensus forecast.
So that's the great part of the story. But, there's definitely some skepticism out there that I hear about, well, just how great this growth story is, and is it too great? Is it, in fact, a bubble that there's so much money chasing private credit, and seems like every manager, every investor wants to be in the asset class? So what do you say to that? Is private credit in a bubble? Are there any concerns?
So the stat that gives me a lot of comfort related to that is actually the amount of capital that is going to first-time private debt managers versus established private debt managers that have 4 or more vintages. And if you look at the data from Preqin, since 2022, when the Fed started hiking rates, actually private debt established managers, so 4 or more vintages, have captured 86% of the fundraising, which is actually well above the trend of 2019 to 2021. The flip side of that is that new entrants in private credit have raised only around 2 to 3% of total capital since that time, since 2022. So to us, what that means is, as the Fed was raising interest rates, as the cost of capital was becoming more onerous, investors were more discerning about where they were allocating capital. To me, that shows the discipline is still alive and well in the market. And that is something that I think we would expect to hold going forward as investors seek to do business with fewer asset managers and really focusing on those that have the depth and breadth of expertise. And for, I think importantly, the workout and restructuring knowledge if it comes to that. The other stat that I would say is that actually as this asset class has continued to grow and kind of age, the loss performance has actually been fairly constructive, both in its own right, absolute terms relative to the income generation, as well as loss performance relative to public credit. And I think that has given a lot of investors comfort so that when they think about private credit, and it goes back to your earlier question, why do we expect this growth? I think as time has gone on, investors are questioning whether or not a neutral or underweight allocation to alternatives more broadly, and especially private credit, makes sense.
Right. And certainly when you look at the statistics and you look at the risk-adjusted performance of private credit, it fared far better versus the publicly traded high yield and leveraged loans. And if we look at the forecast, we're still expecting higher returns with lower volatility. So I think investors are starting to really understand that. And there's certainly a place for that in the portfolio. But Amanda, let's talk about the public versus private, because that's still the question that inevitably comes up. And especially in this environment where public markets are now wide open and we've seen the broadly syndicated issuance of high yield and leveraged loans and IG paper really pick up, and in some cases to record levels. So is that set to displace some private credit? Is it going to refinance some of the transactions? And does that kind of stall the growth that you were describing?
We see a world in which all of these markets kind of coexist peacefully amongst each other. I think for a lot of borrowers, the decision is where can they get the best mix of pricing, certainty of execution, and flexibility. Some borrowers, that will point them to the public markets. Other borrowers, that will point them to the private markets, depending on where they are in their growth journey. We already know that even as the syndicated leverage loan and high yield bond markets have been wide open for the past few quarters, actually we're seeing data that shows private credit refinancing debt that was in the public markets and vice versa. But I think what it just shows is that that kind of financing mix, as we refer to it, will ebb and flow over time. There will be periods of time, choppy markets like when we saw early August, where private debt can step in and provide kind of certainty and of execution and really provide that financing. And there are periods of time where it will skew more towards the liquid side. But I think these are kind of long-term trends. As we know, markets will be in flux. Markets are wide open today, but they could change very quickly. But we don't view that as curtailing the growth backdrop, because for a lot of borrowers, it's not just about price, but it's also, do they really value that long-term relationship with the lender?
And sounds like there's no shortage of opportunity, really, for both public credit facilities as well as private credit. And speaking of opportunity, my last question for you, Amanda, is just where exactly do you see the biggest growth opportunity today? Is it in the U.S.? Is it in Europe? Is it in direct lending? Is it asset-backed finance or something else?
Sure. I'll point maybe first to a trend that our colleagues in the BlackRock Investment Institute have pointed to, which is the build-out of artificial intelligence and the significant amount of capital investment that will require. Their estimates is that will require $3 trillion of capital investment by 2030. The quantum of financing likely cannot be solved alone by governments and public debt markets. So I'd say there's a very real role for private markets and private debt in particular to play in the financing of those longer term structural shifts, most of which will require multiple rounds. And so I'd say private asset-based finance, lending to IG borrowers, financing for these longer term structural shifts is, I would say, first on the list. There's also a lot of scope for growth outside of the US. So North America is by far the largest market for private credit, but actually there's a lot of growth still to happen in that region, and in Europe and Asia, where the economies are more reliant upon bank lending. We also see an opportunity for that diversification of funding sources to really gain some momentum. Those are very regional, heterogeneous markets where local expertise is really important. And then third, I would just say, is the ongoing expansion across investor bases. So insurance, retail investors, in addition to the traditional institutional investors that are asset liability matching. There's multiple facets of the growth forecast. We see actually multiple avenues of growth going forward.
Amanda, thank you so much for sharing your perspective on all of that today, and really enjoyed hearing about the growth that you see in private credit, what's driving it, as well as helping us really understand how to appropriately evaluate that growth and really having to, size that up against the size and scale and what is it ultimately doing, which is partnering with some of the private equity sponsors. So Amanda, thank you so much for that, as well as outlining the opportunities. Today in our Spotlight series, we're answering your question of the month, and I've asked iCapital Chief Data Officer Robert Huntsman to help us with his expertise. Robert, thanks so much for being here today.
Thank you for having me.
It's good to see you, and here's the question of the month that I want to share with you and get your take on. How can artificial intelligence help investment management companies scale their businesses, but also protect data privacy and mitigate those data privacy concerns? So, Robert, let's dive in. And I say this is a pretty complicated question, so let's break this up into two parts. So let's take the first part of that is, how can AI help drive and scale the investment management business?
So when I think about scale, I think about being able to do a process more efficiently to increase operating margin. In the alternative investment management industry, one of the biggest problems we have is dealing with unstructured data. It's very time consuming and labor intensive. Artificial intelligence can be used as a tool to extract structured data from unstructured data, which can significantly reduce the amount of time that it takes to process documents, to do things like subscribe to a fund, to complete an offering memorandum, or other parts of the investment process. AI can streamline those processes. AI is very efficient at analyzing large bodies of information and being able to extract insights, to be able to look at patterns in historical data and to predict forward. I think we're still at the point in time where human judgment is very much a part of the equation, but humans can use AI as a very powerful tool to reach insights that they wouldn't normally be able to reach because they simply don't have the capacity to analyze that much data.
Right. And how far along are we, do you think, in both operationally adopting artificial intelligence and also maybe using some of these predictive modeling in making financial decisions?
In terms of using AI for operational efficiency, we're very early on. A lot of work continues to be done manually. We're very early on in using large language models to be able to extract information to transform unstructured data to structured data, which is really what is going to take us to moving alts much closer to public markets. I think that hedge funds and some alternative investment managers have been using AI for a number of years. So AI, a subset of that is machine learning. Machine learning has been used by large firms like Renaissance Technologies for years to be able to find relationships in large sets of data. I think for predictive purposes, for investment management, decision making, AI has been a very big part of the equation for a part of the industry for many years.
Robert, it's interesting from a macroeconomics perspective. One thing we've noticed recently is the productivity in the U.S. has actually picked up since the pandemic. And I think what it has to do with is some of the technology tools that we now have at our disposal that we didn't have before. But I don't think that includes some of the AI technology tools just yet. So I'm personally very much looking forward to seeing the productivity boost and the operational efficiency that we may have. But let's talk about the other side of that, and that is the data privacy concern. And I don't know if most people realize that, but whatever you type into the public ChatGPT is not actually private, is it?
That's right. The large language models are the models that are used for ChatGPT. Large language models are also the tool that we use to transform unstructured data into structured data. We'll take a model which has been pre-trained on billions of pieces of information, put it into our own environment so that there's no access from the outside, train it on data that we have the rights to use to be able to learn the patterns in that set of data, all within our own environment and all without using any PII, so that A, no external parties have access to that data, and B, no PII is exposed.
Right. So as a consumer, I want to be careful. Where exactly do I put in my personal investment data? Robert, as you think about priorities in terms of data and artificial intelligence at iCapital, what are those?
We sit in a unique position at the intersection of wealth management and the alternative investment managers. We have an opportunity to streamline the industry, to take it much closer to public markets in terms of speed and scale. Our top priorities this year are, one, we are going to use artificial intelligence to streamline the subscription process, which today is a very manual process. And number two, it's about creating reference data, which can accelerate the process of launching new funds, of providing key reference data to use in the subscription process, and for reporting and analytics.
Right. But I think one of the distinction with public markets is that what the pricing is at any given point in time. And I'm not suggesting we're going to get there with private markets, maybe, nor should we, but can we shorten the time period between, investing and actually getting the information on your returns?
There's a lot of reconciliation that has to happen. Our industry is very disaggregated with respect to information. So at iCapital, one of the things we've done is use distributed ledger technology to combine data from multiple different data sources into a single consolidated position source that spans all of the different types of investments in the industry. Number two, you can use artificial intelligence on that single data source to be able to very quickly identify where there are differences in the data from different data providers and to reconcile that data quickly. So while the pricing might not be available in a matter of milliseconds, we're moving much, much closer to being able to provide performance data quickly.
When you have one set of public data that looks at, time-weighted returns, and then on the other side, you're looking at IRRs or multiple invested capital, for alternatives, that's not exactly apples to apples. So if we can use AI to turn that, apples and oranges data into the same structured data, that would be incredibly helpful.
Absolutely. We have a team that has developed a product called Architect, and Architect is a portfolio construction tool for the alternatives investment industry. One of the big breakthroughs we had this year is that we were able to model the alternative investment return and risk structure so that we were able to blend alternative investment profiles with public market investment profiles so that an investment advisor or client can go in and they can construct a portfolio consisting of both alts, structured investments, as well as public market investments, and have a unified view of risk and return in the same portfolio, which is something that really, as an industry, we haven't been able to do yet.
We have not. We know where the pain points are, and we know the massive amount of data that we have as an industry and the inefficiencies that we have. But the good news is we also know the tools that are likely needed to help us get over those. And it's AI, it's machine learning, it's robotic process automation, and it's a matter of time, it's a matter of commitment. And thank you so much for helping us do that at iCapital.
Thank you so much for having me today.
Thanks, Robert. And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today on Beyond 60/40. We'll see you next time.